Hi, everyone. Um, Thank you for joining us today. We have a webinar called Unlocking Capital Through Dealership Sale-Leasebacks. I'm Kathy. I'm the organizer for today's webinar, and I'm super excited to have you here with us. For anyone who is new to Rosenfield, we are a CPA firm with a focus on the automotive space. And we don't just handle the numbers, we like to work alongside dealers to tackle the real challenges that come with running and growing a business. So we host these webinars every month. We want to connect dealers with thought leaders across the industry and create a space where you can all learn, ask questions, and walk away with insights that can make a difference. Today, we are diving into a timely topic for auto dealers, how sale-leasebacks can be used to unlock capital, manage debt, and support growth in today's shifting market. We've got a great panel lined up, two experts in the automotive real estate, Dan Garces and Ned Hennessy, who will be sharing what they're seeing in the industry, along with insights from Ken Rosenfield, who will be sharing the tax side. So together, they'll give us a well-rounded perspective to help you think about your own dealership's real estate decisions. And to keep the conversation flowing, we've got Alicia Webb as our moderator. One quick reminder before we get started, this is designed to be an open discussion, so please use the Q&A chat feature and as we go, and we'll get your questions answered. And with that, Alicia, I'm going to hand it over to you.
Thanks, Kathy. Well, this is a really interesting topic that I'm happy to learn more about. I've always been a little bit intrigued by the whole sale-leaseback structure. And since we all know that at its root, the automotive retail business is all about real estate, I think it's even more relevant today because everyone's looking for sources of capital, right? So with that, I'm going to turn it over. Well, here we have why you should care, right? Because this is designed for any size dealership. Never say, oh, I'm too small to care about this, because you're not. In fact, if you're small and you want to get bigger, it's a great source of capital. And it's so, we can all use practical insights. That's what we're going to get. So with that, I'm going to turn it over to what we're focused on, sale-leasebacks. Sale-leasebacks as a tool to unlock capital. And over to you, Dan and Ned.
Thank you.
Thank you, Alicia. We appreciate that. This is a great opportunity to just share, like you said, what we've seen, Ned and I, in the industry. And, we just want to talk, more generally about what we're seeing in the market dynamics today, where shifts are happening, and kind of share our experience and what we've seen in the market. So we're happy to be here.
Yeah, likewise. Yeah, happy to talk about, what we're seeing, like Dan said, in the market, trends sort of at the macro level, influencing dealer behavior and volume with this, source of funding, and then, how different elements are can be taken into account to kind of better understand what is driving, I think, this lever, and some of the things that I think dealers should be cognizant of, and things they can take advantage of as it relates to sale-leasebacks and maximizing the value of their real estate to fund growth and really optimize their business for the long term.
So one of the market dynamics you had listed here is the shifts in interest rates, valuations, and lending environments, and that's really looking at how you're financing your real estate and your business as far as acquisitions as well, with the debt environments today. And we're hearing probably interest rates are going to be dropping a little bit more this year, with the Fed announcing more cuts, but really rates are still much higher than they were 4 years ago, and long-term rates have been kind of steady. So, what we're seeing in the Fed is more short-term rates, but the long-term rates are pretty steady with real estate. and they're nowhere near where they were 4 years ago when money was very, very cheap. So what we're seeing now is, higher interest rates definitely have an impact on value of real estate too, because higher interest rates will effectively increase the cost of carrying real estate, which puts downward pressure on the value of real estates. The other thing that we see with valuation is the banks are tightening. Loan to values are getting tighter, lower loan to values. We used to see 85% LTVs from the banks, maybe even 90 sometimes, very rarely. But now we're seeing it at 75% and even 70% LTV. So, their capital constraints are getting tighter, which means if you're mortgaging your real estate, you're going to have to put more capital up front to get that loan done. Because the lender's appetite certainly has decreased on the real estate side of things.
Yeah. Pivoting from that, I think, we've seen, interest rates normalize, certainly much higher than they were, 2020, 2021 too, but, lower than, where we saw rates, call it in 23. And, I think we're going to see, a pretty stable environment over the next, call it 12 to 24 months. Rates, have been cut, but we actually saw, a slight increase in the 10-year, which is effectively the risk-free rate as far as the lending environment goes. And I think, that's going to be, kind of the topic on everybody's minds over the next, several months here. I think, recessionary fears, consumer buying power, and kind of what is going to happen with, the overall economy, are drivers of those rates, and they're drivers of, sort of the credit outlook that, these banks are going to have. And so I think, as Dan said, we are seeing similarly, an environment where, banks are pulling back. Banks do not want, tremendous real estate exposure relative to, their other lending lines. I think banks, if they can get, they're more than happy to allocate, funds on the real estate, so long as they can get the other business from the dealers, the floor plan, the working capital, et cetera. But as far as, just traditional real estate exposure, I think we see, even large banks kind of tapping out in kind of the $50-75 million range from a single dealer. At that point, you'd have to syndicate, and it becomes kind of complicated. So, we're seeing, tightened LTVs. Rates are higher than they were, but, lower than, at a pretty, medium, range, I think, if you look, far, dating far back. And so, you've got, downward pressure of margin compression and higher borrowing costs and inventory that is, at levels that, pre-pandemic levels. So, it's going to be an interesting, I think, environment to see what, how all of these pressures and elements kind of coincide to kind of give us the landscape moving forward.
What kind of LTVs are you seeing from? I know the banks are really tightening them up. I mean, what kind of, you seen, how much more equity are the banks requiring, and what have you guys seen from some of the private equity groups in terms of what they're requiring on real estate acquisitions too?
Yeah, I mean, Ned, go ahead. Sorry.
Yeah, I mean, I think, as far as, just banks, I think, 65-75% kind of is your run of the mill, 25-year AM, but I think, you're seeing rates anywhere from, call it the, really, really, solid product, I think, maybe high fives to, kind of mid sixes. But yeah, I mean, I think LTVs are the concern. It's, it's the exposure that these banks and funds want to limit. And, that then limits the amount, or I guess it increases the amount, the dealer then has to come up with, and it's, it's more capital intensive. And so, That's, I mean, 65, 75%, I think for, you can go to a debt fund and get, higher, but you're going to get, you're going to have to, pay a tremendously high rate. We're talking 10+%, likely 12+%. So,
Yeah, and it's 70% on, an average real estate transaction. Let's just say a dealership, for simplicity, is $10 million. I mean, that means you have to write a $3 million check of your own capital to acquire that piece of real estate to finance it. And you multiply that by 2 to 3 stores in one transaction, or even 4 stores. I mean, that could be 9, 10, $12 million of capital that you need to come up with to get just the real estate portion of the acquisition financed.
some of these dealerships, are much more than 10 million. So
Yep.
that number can get steep, I think, pretty quick.
It multiplies very quickly when you're doing multi-store transactions, or if you're doing $30 or $40 million pieces of real estate, which we see often.
Right.
There's also still a lot of non-compliant facilities out there, so they got to add sometimes the cost of that into the structure as well, of getting them compliant.
Yeah, and that's a good
Right.
segue to the M&A trends, because what you're seeing with M&A, whenever there's a new acquisition, the manufacturer kind of puts their hand out and says, we need to do some updates to the building. We want to refresh the facility. So that increases the real estate cost. That increases the investment that the buying dealer has to make in the acquisition. And so, financing that is also a challenge. So you need to be ready to be able to finance the acquisition and also any future construction as you're looking at acquisitions. And that's something we certainly can do, is, come in, purchase the real estate, and have a commitment for, the construction that needs to be completed on the property as well.
Yeah, I think, just M&A as a whole is typically, a large driver or catalyst of, sale-leaseback activity, right? It's the capital that is unlocked, whether it's simultaneous to a transaction or, unowned real estate to then go, kind of war chest cash to grow. It's typically, I mean, it's because, dealers want to go, buy more dealerships that are, expensive. And, I think we're seeing a slightly slower, M&A environment given, the uncertainty, I think, that the tariffs have created. But, I think we're going to see that pick back up as, things normalize. And I think, we're going to be in an environment that is, again, it's constrained as far as, the capital that dealers can get elsewhere. And, I think there's going to be, a real push for, alternative capital. And I think, sale-leasebacks are an excellent way to, again, unlock capital in your own real estate, to war chest, cash as a, a means to go out and say, hey, I've got, X amount of capital and this is what I can go do with it. And I think that, strategy is very, advantageous. It allows, a little bit more flexibility having that capital to then go make your decisions with. But, that can be, combined with, another strategy that, dealers use where, it's a sale-leaseback simultaneous to the, M&A transaction itself, where, outside funding is used and to fund the, the acquisition, element of the real estate acquisition element of the, M&A transaction. That value, typically can be increased beyond the, amount that, the selling dealer, requires. Call it the appraised value. And, it actually creates, a creative scenario for the dealer where, they're maximizing that real estate value, getting a little bit, more capital to then, pay down, that blue sky multiple at the acquisition. And, it increases, the return the dealer's receiving, or it makes the buy effectively lesser, at the point of sale. And so, those are all, I think, trends that coincide with, the real estate and M&A. But I think, as a whole, we're seeing this, slight normalization, with the M&A market. People are kind of scratching their heads. What's going on with, valuations? Things, peaked, the last, 4 or 5 years. They're normalizing. Profits are about, double what they were pre-COVID. Multiples are about the same. This seems to be kind of a new normal. Tariffs obviously were a head scratcher, but that's, I think, not going to be a long-term impact. And I think as we see, more of a stable environment moving forward, and a pretty static capital environment, like we mentioned with rates and LTVs. Now that the landscape sort of set, I think sale leasebacks and the ability to and the real appetite there is in the investment real estate market for this this asset class, and to to allocate this form of capital. I think we'll see it in a tremendous way next year, the year after, and kind of going back to a more normalized environment where we're not seeing 2% interest rates and every single bank trying to get as much money out the door at the highest LTV. So yeah.
Yeah, I mean, I agree that M&A activity, it peaked in 2021. I mean, there were over 700 transactions done back then. And every year since then, 22, 23, 24, we've seen a decline in M&A activity to a more normalized pace, let's call it, like Ned was saying. However, on the flip side, I do think there's been a growing interest on the sale-leaseback part of it. We've seen more activity over those 3 years or 4 years, growing each year consistently. So like last year, 2024 was our best acquisition activity in 7 years. And this year we're ahead of that pace. So we're seeing more dealers kind of recognizing the use of this capital source. They get a better return on their operations. So that's where they're focusing their capital when you compare it to the returns that they would get on the real estate. So, what we have seen now as dealers are using more of the real estate, our capital for the real estate, or sale-leaseback capital for the real estate, and focusing their own capital on operations, which is generating, let's call it 20 to 30% returns on equity versus much lower returns on the real estate.
Yeah, I agree. Yeah, go ahead.
So I find it sometimes hard in my mind to sort of figure out how the interest rate affects all of this. If interest rates are in fact going to go down, but they probably aren't going to go down that much, does that make sale-leaseback more or less attractive? Like, how does the interest rate environment figure in to the attractiveness of sale-leaseback?
Well, I think as Ned said earlier, the 10-year rate is more stable, and long-term money, even 20 and 30-year money, isn't moving as quickly. So, a Fed rate change on short-term interest rates doesn't affect as much, what you see on financing long-term money.
Yep. Yeah, I mean, I think it's it can be a colorful answer. How do rates affect potential interest in sale-leasebacks, or sort of appetite as for sale-leasebacks as an alternative, or value? I think it's there's multiple aspects. So when interest rates go down or up, you've got either a cheaper or more expensive cost of capital. I think as we've seen the rates go up significantly, and I think also to add to this, there's a tremendous amount of debt, and maybe we'll get to this down the line, but I think it's worth noting, there's a tremendous amount of debt that was sort of aggregated, or issued of the last over 2020 through 2022, right? We had a tremendous amount of M&A activity, probably the highest we've ever seen, definitely the highest we've ever seen. With that acquisition activity, we saw a tremendous amount of debt being put on these deals, and that debt is now coming due. I think we've got about $2 trillion in corporate debt, aggregate corporate debt coming due this year, next year. I think that number is, I think it's about 14 or 16% of the total, corporate debt load. And then we've got, tremendous amount more over 27, 28, 29. That debt is going to have to be refinanced or paid down at, rates much higher than when it was issued. And so that puts a strain. Some of these businesses, almost all of these businesses are doing, lesser we'll talk dealership specific. Most of these dealerships are doing, much less in profitability than they were at that time. And so all of the, kind of fundamentals of that debt, have to change, and the valuations of these businesses and real estate, have to change. And so, I think, the cost that is, going to go up once, this debt's refinanced, or the prospect of it is very, concerning, I think, to a lot of businesses, a lot of dealers. And I think, sale leasebacks are a way to, take out, unlock some capital to sort of mitigate some of that damage. And I think, as far as interest rates and sale leaseback valuations, or why, sale leasebacks, may be more attractive. I mean, if we see, it's not necessarily how, rates being cut don't just mean, cap rates go down. I think that's a misconception, that I think it's worth addressing. I think a lot of people think, oh my God, interest rates are getting cut, cap rates are immediately going to go down. It doesn't, really work that way. I think it's, a positive that interest rates are going down for the, the overall economy. It also probably means that we're expecting, a bumpy road ahead, right? And we're bracing for that, or it's, reactionary, because the economic data is not good. And so, I think, we'll see, potentially some compression in the cap rate side. I think cap rates are probably relatively normalized, and I'll speak for what I see. And Dan, I'll let you speak. But I think, I think that the rates being cut it could be a positive. I also think it needs to be considered, potential indicator that we are weakening as an economy. And I think, as far as cap rates go, again, it's relatively stable. I don't think we'll see, tremendous cap rate compression just because these rates are being slashed.
Yeah, and the same thing happened the opposite way when rates were really low and they went up very significantly, over the last 3 to 4 years. Our cap rates didn't move at that same pace. They didn't go up that much. So I think cap rates are still pretty stable. I would agree with Ned on that they're not really affected, that much by these short-term rate changes.
Shall we move on to the next slide?
Sure. So here we're just talking about comparing, the capital option sale leaseback versus traditional debt. And we've talked a little bit about this now already, but I mean, my big overview of this really would be to say that, sale leaseback capital is less expensive than private equity, or, your owner's capital or your own cost of capital. And sale leaseback capital will provide a bigger advance than you can get from traditional financing through mortgages. So you can get more capital out of a sale leaseback, and it's less expensive than your own equity or private equity or a partner.
Yeah, I agree. I mean, fundamentally, sale leaseback is, a tool to maximize, or to provides the opportunity to maximize, real estate value, or underlying real estate value owned assets, or, developments, or real estate that is, a part of an M&A transaction. And, that value, that underlying value, again, it's if we're talking debt, bank debt, call it 65, 75% LTV, you're talking, 100, percent plus, up to, call it 140% in some cases of a sale leaseback. You're talking about, much more, greater access to capital at, comparable rates to debt. Typically without, a lot of leaseback or, restrictive elements to, the balance sheet. So, you get, sale leasebacks, more capital, comparable rate, and typically less, restrictive as far as, covenants and balance sheet kind of items go. And then I would say, as far as private equity, I think the biggest thing is you're not giving up a piece of your pie, right? You're not giving up, operational equity. You're not limiting, or restricting governance of your business. And the cost of sale leaseback capital relative, to private equity, returns that are really needed, you're talking about, call it, mid, 6.5, 7.5%, with the sale leaseback versus, 15, 20, 25%, plus with private equity. So I think, I think the biggest things we see from dealers that, want to grow. I mean, capital injection is needed, right? It's almost everybody needs it. Businesses big and small to continue to grow. You're looking for, I think a lot of dealers look to sale leasebacks because you're not trading equity in your business. This is going to be my business wholly, and I'm not going to give up any sort of governance or control to someone else. I'm going to maximize the value of my real estate. So while I'm selling my real estate, its value is going to be maximized. And then assuming that and I think this is extremely important, an attractive lease can be formed between dealer and capital partner. I think it's a very, very attractive alternative capital source that we've seen dealers and as Dan mentioned earlier, really showing an increased appetite for. I think we'll continue to see that into the next year and thereafter.
What do you guys see as a turnaround time compared to like bank financing and stuff like that? The sale leaseback transaction move.
Turnaround time?
Yeah, to get a deal done from the start to close. I mean, for us, we can certainly get in there after an LOI is signed. We can generally close on a transaction within 45 days. Sometimes a little quicker than that. It's partially driven by how much diligence has already been done on the property. So we can get through the environmental and the phase, the appraisal and all those other pieces, understand the survey on the real estate, check title. But those things take about 30 days usually. So, we bake in another week and a half or so for closing and getting through the docs as well. So it's about 45 days. Certainly we can do it faster. And sometimes it takes longer depending on complications. I don't know, Ned, if you have a different experience with that.
Yeah, I mean, diligence, I think with most, and again, I think it depends on what the dealer's after, right? If you can run, more of a flexible process, or allow us to run a more flexible process that, does not have time constraints. Typically, that's either a development or a more commonly a M&A transaction that has a legitimate deadline. I think your diligence is going to be relatively the same. Real estate diligence, cash close, 30 and 5, 30 and 10, 30 and 15. So between 30 and 45 days. Kind of all in. I think I think it just kind of depends on what you're after. If you can run, again, like I said, a more flexible process that allows the market to be utilized and us to find something that is premium without a deadline. That process can take longer because you have the time affordability, but I think if it's an M&A transaction, it's we can meet that deadline, or facilitate capital contingent, with the development of a new dealership, and meet that timeline as well. We rarely run into instances where we've missed, or I can't say we've ever really kind of missed the boat in terms of timing, but I think it's all relative to kind of what the situation is.
Yeah, makes sense. Yeah.
And some of the key considerations we have listed, we mentioned here are, flexibility, risk, and long-term impact of considering, your options, whether it's sale-leaseback or traditional debt. Certainly, from a flexibility perspective, your lease terms really drive that. So, make sure you understand your lease. We have assignability clauses. We deal with assignments pretty regularly within our leases and in our portfolio, where a dealer may sell their store, 5 years into the lease or 10 years into the lease, and we just assign that lease to the new buyer. Substitution is something that we offer within our structure, where we can, replace a property. Let's say you outgrew the store or the facility, 6 years into your lease, and you need to move the dealership. We can substitute that asset within our portfolio, so we can sell back the old property, take the economics of the original lease, move it to a new location, and then fund any new location, construction or development of the new location as well. So flexibility is really, really important to understand, what your options are when you're considering sale-leaseback. I think from a risk perspective, if you do a mortgage, you're typically going to refi that mortgage every 5 to 7 years. That's generally what commercial lenders are looking at in term. Sometimes they're 10-year mortgages, but you're taking interest rate risk when you're doing that, because you don't know what the interest rate environment's going to be in 5 years or 10 years. And you do have to refi that property at that time. Whereas in a lease, you have a long-term lease with a predictable rent stream, for the duration of the lease, which generally could be 20 years. With renewal options, you could extend it to 30 or even 40 years of a predictable rent income stream, and not take that interest rate risk, not take that refi risk.
Yeah, I would agree with all those things. I think flexibility, risk, and long-term impact, as it relates to call it our three sale-leasebacks being our topic, but how are those flexibility, risk, long-term impact factors? What is sort of relevant and what to watch out for across the forms of capital. I think Dan hit it on the head. Flexibility in the lease. If we're talking sale-leasebacks, is paramount. You need to limit as much operational impact. Whether it's assigning the dealership, whether it's any sort of covenant or anything that is sort of attached to that lease that could limit maneuverability, selling the dealership, or performance fluctuations that carry a cost, or expansion of a specific piece of real estate or the business itself. And so I think those factors specific to flexibility, specific to sale-leasebacks, are things you need to be cognizant of. And I think we do a tremendous job at and utilize very, very key resources to ensure that all of the clients that we represent are in very premium leases that achieve the capital they're looking for with without limiting themselves down the road, right, and creating a long-term impact that is negative, right, for a short-term injection of capital. And I think again, it's kind of back to the what I said in the beginning. I mean, the reason that dealers prefer or have a strong appetite towards sale-leasebacks versus debt and versus private equity, you maximize the value of your real estate. You get to control and dictate what happens in your business, and nobody is going to take a piece of that, take a piece of the equity, or have governance over that. The rate, is going to be comparable to debt. The proceeds are going to be more than debt, and the rate is going to be much, more attractive than private equity. So I think, while again, sale-leasebacks I think are not for everyone, they are an extremely attractive tool. And especially comparable, in comparison to these, other forms of capital, and so.
Yeah, so I think our last bullet here, when it's sale-leaseback may be the smartest move. I mean, certainly as Ned was kind of saying, when you want to maximize your ROI, if it's on a new acquisition, that's a terrific time to use it. Certainly people have used it for estate planning to reduce exposure to auto retail. They may sell the real estate portion, keep operations, and then take the proceeds from real estate and invest in something completely different out of the automotive industry, so that they've now diversified their estate, from a risk perspective. Also, funding a partner buyout is a terrific option or reason for doing a sale-leaseback as well. I mean, there's lots of reasons and ideas of how people have used sale-leaseback, or examples of how people have used it before as well. So we can cover some of those too.
Yeah, I agree. I think we'll get to that, sort of case studies and use cases, why it, makes the most sense. But I think, it's growth capital, it's recapitalization, paying down debt. It's, opportunistic investment elsewhere, diversifying estate planning, allowing yourself to, maximize the value of those real estate assets and then move it, on your terms and your timeline. And I think, we've seen it in partner buyouts as well, as a way to, raise capital, to, pay, a partner or partners out, in an instance where, ownership interests have changed, and, it's either sell the whole business, which, one or a couple or two partners may not want to do. And instead, you can, liquidate real estate and, maintain the business and, satisfy, the interests of those partners that you want to get out of the business at that time.
Probably next slide, Kathy. I guess this is where this boring CPA comes in now.
I think we're
There are
on.
Oh,
quite
I'm
a-
sorry. I skipped
Oh.
to your slide, Ken. My bad.
No problem. Okay. Yeah, the rest of that's for Ned and Daniel. So there are quite a few tax issues and considerations to go over when you're looking at doing a sale-leaseback. I mean, obviously, as we've said, the key point is leveraging your asset to obtain capital is a great way to do that and control your forward-thinking lease. Leases are fully deductible, where there's no limitations or anything on leases. So real estate leases are always 100% deductible. And in some states, like including Florida, currently, there's been sales tax considerations on top of leases, where they've had sales tax on commercial leases in Florida, which that's always been a big issue. That's going away in the state of Florida. They're actually doing away with sales tax on commercial rents, which would be a good thing. The lease payments are fully deductible, where with a traditional mortgage, there are interest and depreciation limitations. It's kind of a simultaneous equation you have to run to see what gives you a better benefit, deducting your interest, which is on mortgages and your floor plan, versus how much depreciation you can take. The One Big Beautiful Act that was enacted here recently made some changes. So it allowed the computation of how much interest you can deduct to be greater, but it's still limited, and there's still depreciation deduction limitations as well. So with the sale-leaseback transactions, your leases are 100% deductible. So it's one way to get some tax advantage of having expenses. And some of businesses, real estate's older, or if you use some cost segregation studies or some accelerated depreciation techniques, you may have a fully depreciated asset and there's no more depreciation available. This is another good way to get equity out of your asset, real estate asset, and now get some more deductions in terms of leases. So those are good as well. If you're still trying to minimize your payments and see where your overall cash flow is going, and you don't want to pay tax on the sale of your real estate, these transactions are eligible for 1031 exchanges. And that's for forward-thinking 1031s or reverse 1031s. They all qualify as a 1031 exchange. So these are things you can look at as well. So if you don't maybe need as much cash, or you wanted to do something else with the funds or invest in something else, Daniel mentioned earlier, getting multiple pieces of property, 1031 exchange may also work into the the computations and the waterfall of the cash flow with everything that you might want to take a look at doing a 1031 exchange. So those are the big items, from a tax consideration. If you're in Florida, the sales tax on commercial leases is going to be eliminated, and the leases are fully deductible. And if you have fully depreciated properties, this is a way to kind of regain some expenses out of the same piece of property. So you're kind of getting some double expenses out of that. So those are the real big items as far as estate planning and other types of taxes. This is a good way to, if the estate might be rich on real estate and short on cash, this is another good way to liquefy your estate and move things around and incorporate it in conjunction with your estate planning as well, and move the asset out of your estate, put the cash as a replacement, and you can invest that in other things as well to diversify what your estate's investing in as well. So that's another consideration to have.
Yeah, and Ken, you mentioned 1031s, and that's obviously, selling a piece of real estate and investing in another kind of commercial real estate asset. We also can do a 721 exchange, which is the UPREIT structure, which is another way to defer capital gains in real estate, and is a great estate planning tool. So instead of taking your 1031 and buying another piece of real estate, you can contribute the property to our portfolio, to the REIT, and then
that's very effective.
Right.
I've known Dan a long time, and his predecessor Bob just as long. And it's a great organization as well. So it's also diversifying your portfolio as well.
That's right. And so you would defer your capital gain on that piece. And the nice thing about the 721 is you can take units in the company and they're divisible. So you can divide them among family members, or across a trust, or even use it for charitable contributions and things like that. Because selling or liquidating some of the units doesn't trigger a tax on the remaining units. And then what you have is a passive income stream. As if you kind of owned the real estate, you would just get a dividend and a distribution on your shares. And that's a passive income stream, versus if you bought into a 1031, you'd have to manage that other commercial piece of real estate, whether it's by refinancing it every 5 to 7 years and, handling the issues on the property and things like that. So, instead of managing your own real estate, you would just be a passive investor, and you would just kind of collect a coupon, which is a nice retirement tool as well. So that's another
also a lot less fees with your concept as well. You don't have management fees and brokerage fees and all that kind of thing. So you eliminate a lot of that additional expense. So you have to have more to invest as well.
Correct.
Yeah, and I think as far as 1031 exchange goes, we've seen the multitude of the net lease market, multitude of investors in the net lease market use this tactic. We've done about $40 billion worth of business. A lot of that has been 1031 exchange buyers and sellers, and working with intermediaries to facilitate those deals and take advantage of the tax code. But I think as far as dealers, we've seen kind of two scenarios dealers use that I think have been particularly lucrative. The first being dealer has X amount of real estate, for estate planning purposes. They want to diversify the maximum, get a maximum amount out of that real estate through a sale-leaseback. And then take that capital and reallocate it into diversified portfolio of real estate assets. It allows you to start depreciating. If you've held real estate for a long time, and you've kind of tapped out on depreciation and continue to defer that. And also, obviously defers, capital gains, allows you to kind of aggregate and continue to aggregate, a portfolio of real estate outside of your dealership business. So you're not, exposed, in terms of your real estate assets and your operational assets in the same, sort of sector. And I think that's a way that we've, been very active with 1031 and seen that, to, in effect. And then I think too, we've actually, facilitated, several of these transactions where dealer owns, real estate. And again, it could be fully depreciated, or it's simply a form of capital. And sale-leaseback occurs, and they actually 1031 exchange into the real estate of one or more dealership assets in an M&A transaction, and kind of continue to do that and roll real estate equity into their growth plan as they acquire more dealerships in real estate. So that's another interesting thing, I think, that in a way that we've seen 1031s used, and to the benefit of the dealers that we represent.
Great. Next slide. Yeah.
You got it.
So the real world examples, I mean, this is a great slide. I mean, we have so many examples in each of these buckets, whether it's partner buyouts, estate planning, dealership expansion, all of these, we have great examples for them. I'll just start with one. I mean, the partner buyout one, we had two dealer partners. One was near retirement age. The other one was in his early 50s. The group had 12 franchises at the time. They were 80% domestic, so they were pretty concentrated on the domestic side of things. The older partner wanted to retire. The younger partner, didn't have the capital to buy him out. He also had a son who was just starting out in the business, and he wanted to have a business for his son to be able to operate as well at some point. So the solution was, we did a sale-leaseback on the real estate. We got the retiring dealer, all of their capital out of the real estate, and then the remaining dealer, used the capital that he got out of the real estate and bought the shares of the retiring partner. So he was able to fund the acquisition of the stock basically by selling the real estate portion. So he gained control of the business, and he preserved his opportunity for his son to eventually operate and control the family business. We were able to remove personal guarantees that they had on their bank, because on the sale-leaseback, we generally don't require personal guarantees. So they kind of reduced some of their own personal exposure to the business as well, which was a terrific story. And then a few years later, that same dealer group had the opportunity to buy another platform of stores, but they didn't have enough capital to complete that acquisition at the time. So, we funded the real estate part of that acquisition of their growth, and they financed the blue sky, and they completed their expansion. So over the next several years, they just continue to keep buying stores, and they've transformed that business from what I said, 12 franchises with 80% domestic exposure, to now 41 franchises, 80% import. So really been able, and a lot of Highline too. So they've been really able to change the profile of their operating business by using sale-leaseback capital. And they didn't do it on every deal, by the way. So several of the stores they bought, they just financed traditionally, and some of the stores they did was sale-leaseback. They were able to pick and choose which ones they wanted to strategically own in their own portfolios versus doing sale-leaseback for the others.
Yeah, I mean, I think all of these examples, have extremely, good case studies that we could represent. I think, as far as growth capital and dealership expansion, I think that's typically, what we see the most. I think, as Dan said, partner buyouts, we see, some estate planning, taking chips off the table to be, reallocated, whether it's, into real estate via 1031 exchange, or into alternative assets before the sale of the business. We were involved in a transaction recently where there was a significant amount of covenant being breached with client's bank, and there was a liquidity event effectively, or kind of a takeover of the business's assets if a capital injection or didn't occur. And so I think and I think this is going to be, again, a trend that we see as all of this debt that was issued, over the last, call it 5 to 7 years, kind of comes due. And, this particular instance allowed a client to a dealer to create liquidity via the real estate, pay down debt, and get themselves out of a scenario that would have ultimately crippled or kind of been the end of their business, and actually reset them on a path towards growth. And I think a lot of the business that we do is with and a lot of the the partnerships that we have are with dealers that are looking to grow. Whether it's dealership expansion, whether it's building new dealerships and looking for capital to fully fund those. Fully fund the expenditure, sort of, we call it a reverse, sale-leaseback, where, capital effectively funds, the, full improvement cost of, a new dealership, whether it's an open point or, you're moving an existing business. It's the least capital intensive, requires, no capital out of, a dealer's pocket. And it provides you with a new dealership, or in conjunction with M&A, right? Whether it's again war chesting cash on owned assets to then go pair with a sale-leaseback strategy with M&A and buy sell activity, or strictly utilizing the real estate, the underlying real estate. On the points that you're looking at acquiring. I mean, we've helped dealers grow tremendously. On kind of every corner of the map when it comes to raising growth capital. Via the sale-leaseback and allowing. I think dealers to grow, tremendously more, tremendously more than they would have, otherwise, without this kind of lever.
Yeah, a good estate planning example we had was, we had a dealer who became a client of ours when they bought a Highline luxury store from one of the publics, and they, it was already under lease with the public, and they took assignment of that lease with us when they bought the store. So that was their first transaction with us, was just kind of through an assignment. But after a few years of really getting to know our team, they began to use the sale-leaseback for their other stores and their other properties. And what they were doing was pulling out the cash that they had invested in the real estate and deploying it into other asset classes outside of automotive. So they were diversifying their estate really from all automotive with dealership operations and real estate to kind of splitting it up. So, they were kind of using the capital for a different source, which was interesting. But this year, we actually just did another big deal with them on 4 of their properties. And instead of reinvesting it somewhere else, they're saying we just wanted to take the cash to have capital ready for acquisitions in automotive. So now they want to buy more operations with the capital they just pulled out of the real estate that they owned. They didn't actually have buy sell in mind. They just said we want to be ready so that we can move quickly when we see the right opportunity. And so they're being very disciplined in their approach and kind of pre-funding the acquisition through the real estate that they already owned. I think that's super important right now in this marketplace, because from an acquisitions perspective, you need to be able to move quickly. If it's very competitive, there's a lot of buyers out there, whether they're coming from private equity or other places, and even the publics who can move quickly. And so if you're a 20 or 30 store group, or even a 5-store group, you want to be able to move fast to compete against some of these other bigger groups.
I agree with that. And I think that's a good point. I'm glad you mentioned that. I think that, cash is king when it comes to, the acquisition of anything. I think, particularly dealerships, and in this market, financing can be a complication. And if you can, remove that or limit that, as much as possible, you become a much more attractive buyer. I think, really good dealership opportunities and really the growth that the dealership space has seen, especially with the 150 and how capitalized that top 50 group is. rolling up dealerships and maximizing footprint is the game. And to do that, you're going to have to win deals. And I think, like Dan said, being able to, perform a sale leaseback, aggregate cash, be flexible, be agile, be able to take advantage of opportunities, and have, be able to instill confidence as a buyer sets you on a pedestal compared to other opportunities, or frankly, it puts you at least in the game, because there's a tremendous amount of cash that is available to go buy dealerships. I think if you are not competitive in terms of being capitalized up front, and really ensuring that you can close, you're kind of out. So it could be a missed opportunity if you are not sitting on the cash, or at least most of it that is needed to perform. And it may be an opportunity missed that is completely detrimental to kind of the growth of the dealership. I mean, when a strategic acquisition comes up, big or small, I think it's very important, especially in this market where they're fewer and far between, to take advantage of them. So,
yeah, I mean, expansion is definitely a big use of where people are using sale-leaseback capital too. I mean, we have a client who they bought their first store in 2010. Now they operate 28 stores, with over $1 billion in revenue. Our first deal with them was in 2018. So they operated their own stores and didn't do a sale leaseback on the real estate until 8 years later. And then we got kind of involved with them at that point, and after that, they bought 20 more stores over the past 7 years. We've customized our deals with them, offering construction financing when the manufacturer requires updates, and we've done full ground up construction for ad points that they've been awarded over time. They've had to deal with relocation options at some point, so they had to move a store from one location to the other, and we're funding those. So, really showing continued flexibility with the dealer, helps them come back, more and more for using this kind of capital, because, there's a trust level that's built up over that time with the relationship and how we can support their growth. And that's always been really important for us, is just to stay with the dealers and kind of continue to support their growth.
We have a few minutes left in
Okay.
our meeting today. We've got a couple more slides, risks and nuances, and then future outlook. And then I wanted to make sure that Alicia could ask a question or two. I think we can go over a couple minutes. I think that's okay. I'll let you guys continue.
I'm happy to hit this one first. I mean, risk and nuances when holding property might be better. I mean, I think, to preach or say that sale-leasebacks are, the absolute, would be incorrect. I think, it's absolutely, it's absolutely not an absolute, but they are, it is a great tool. I think it's an excellent lever. It's a proven lever, right? That, businesses, that are at the top in the dealership space and at the top really in the world, have utilized to, maximize capital within the operating business, maximize returns, both to, shareholders and for the business itself. And, it's proven, right? It is not, it's not a new, strategy. And, but again, I think, there are instances where, sale-leasebacks may not make the most sense. And I think a few of those, off the top of my head are, a dealer that wants, to sign a long-term lease on a property they don't plan on operating long-term, right? I think that's just a bad decision. I don't think it aligns with, the interests of the investor either. I think I could probably say that, Dan. And I think, sometimes there's real estate, depending on, the way that, the dealer or the family or however the business kind of is dictated or operated, that just makes more sense to hold sometimes. And it may be hold and then do a sale leaseback. Maybe it's a dealership that's not performing up to really where it can, and it needs to mature, and then sale leaseback can happen. And sometimes there's sites I think that the dealers should just simply hold, and we've said that. And this is a piece of real estate that has tremendous intrinsic value beyond the dealership, the sale leaseback value, and it's look, this is something that really you should just hold on to if you can. And so, those are some times I think where we've said, look, it's better to just hold this property.
Yeah, I totally agree. If you're going to outgrow the real estate, or if you need to do improvements on it very soon, or you're not sure what you're going to do with that location, then I wouldn't advise somebody to go into a sale leaseback on that asset. As Ned said, I mean, it's right in some cases and it's not right in others. And you need to work with us and your own other advisors to determine which properties make the most sense for that transaction. I mean, understanding who you're working with and what's your use of funds and how you're going to use your capital for growth are the things that you want to be asking yourself as you're considering sale leaseback or other ways to finance.
Yeah, I think that's a big one, right, that you kind of touched on lightly, but I do want to say that I think the sale leaseback, obviously it unlocks capital, but I think a lot of the importance, or kind of falls on what are you going to go do with the capital, right? Yes, sure, you can go, create a tremendous amount of liquidity or capital to grow, or do all these things, but I think a plan is very, paramount. I think just having cash without a plan to do it, with what to do with it it's bad in general. But I think it really can be. It can complicate things and create a slippery slope. And I think it is much easier to sort of, plan and kind of look at things, back to front, what are we going to do with this, and to kind of, plan ahead, and how can this, benefit the business? How can this benefit, the family or ownership in terms of, differentiation or diversification of capital and investment. But I think a plan really needs to be orchestrated. I think dealers that say, look, I just want to go raise a bunch of cash and I'll have the cash and good things will come after that. Not advisable. And I think it can create tremendous tremendously bad situation, I think, down the road.
Last slide.
The next slide.
I mean, so looking into the future, I mean, I would just start with, as far as tariffs, I mean, nobody really knows. Certainly, we're seeing an increase in prices could happen, and that's definitely something we'll see. Increasing prices generally puts downward pressure on sales. I mean, the average transaction price for a new car is already really high, so adding a tariff to that, could slow sales. On the flip side, manufacturers may slow production, which would also limit inventory. And so we know through the COVID experience, limited inventory, because there's less manufacturing, could then increase grosses. So, there's two sides to that coin, I suppose, and you got to consider both. But definitely, I think tariffs will have a negative impact on the volume of units being sold.
Yeah, I'd agree. I mean, I think they've created a real complication. I think we touched on it as far as the M&A market. And we saw a huge buy up of vehicles in the first second quarter, beginning of the second quarter, and that kind of may have created sort of an unpredictable buying market for the rest of this year. And I think tariffs as well. I mean, we haven't really seen the impact yet. The material impact. I think, the fear, created that buying up of vehicles in the beginning of the year, but we don't really know what the material impact is going to be, and then how everything is going to react, because we're always kind of in a reactionary environment to reactionary. I guess we react to these things instead of sort of plan proactively, and so I think it's kind of a big question mark still. I think it was a big question mark at the beginning of the year. I think it still is. I think we've materially seen M&A go down because of it. I think but I think, again, yeah, like Dan said, tariffs are not good, and I think understanding what the negative impact is going to be and how big it's going to be is still kind of to be determined. But hopefully it's swift and it's figured out, and I think it will ultimately limit overall interest from manufacturers to produce goods, right? And that could meet demand, and not a ton happens, or it could really crunch supply and relative to a stable or increased demand, which would be probably unlikely, but it could happen, and then we'd see an increase actually in gross profit and profitability, and it would be ultimately good for the bottom line. But yeah, I think it's really anybody's guess. I don't think we really know exactly where this is going to go, and it's uncertainty is never good, right, for people that need to make important decisions, whether it's a down market or an up market. It's great we know where we are, and we can make decisions based on that. The unknown and kind of waiting for something to happen, again, to react to, is problematic, and it's a kind of creates a limbo in terms of people need to make big decisions, which this that we're talking about is.
Yeah, and I think that the uncertainty also on the new car side creates opportunity on other parts of the business, and we know how dynamic these operations are. So parts and service and fixed ops, the whole back end of the business could benefit from that. There'll also be a little bit more focus and concentration on that because it's a little bit more predictable when sales aren't. So there's opportunities as well.
Yeah, and F&I and fixed ops, I think, has been over the last few years, while we've seen gross profit fluctuate, we've seen pretty much a stability and an increase, obviously, in profitability from those aspects of the dealership, and I think that's a good thing. I think, obviously, if we see less new cars, people are going to be driving their cars longer and needing to be serviced more, and it's sort of a non it's you got to do it, right? I mean, where someone may not buy a new car because the price has increased. They may have to fix a car with an increased a more expensive part and service because it's it's the way they get around, right? And that maybe we see a balance on that side of the business that kind of anchors the lack thereof on the other side. But yeah, I mean, there's a lot of different scenarios I think that we could find ourselves in, and hopefully that if the pain comes, it's quick, and it leads to a more formidable kind of future outlook for the business.
So I have a quick question, and I actually have to go. I have an interview with someone later. I'm interviewing someone, I should say, but the journalist in me always wants to hear both sides of the situation. So I'm wondering, what risks do y'all face? Right? Okay, you're helping the dealer mitigate risk. You're giving them more flexibility, access to capital. On your end, Dan and Ned, what risks do y'all face, and how do you mitigate those risks?
I mean, from our perspective, it's occupancy risk for sure. Like, when we're underwriting a transaction or a new relationship, we want to make sure that is a long-term deal for the dealer that's going to benefit the dealer, because they're what we're relying on to make those rental payments over the life of the lease. So, the risk we take is, a credit risk. Is this putting the dealership group in the right position to be able to effectively service that lease over time?
Yeah, and I think, contrary to that, I think, the risks that we consider and consider really our own are the risks of our clients, right? I mean, due to our position in this space, facilitating these deals to the market, our risk is relatively low. Our risk, our personal or risk is low in these transactions. However, I think there's, we really try to put ourselves in the shoes of our clients and, and figure out, exactly what the potential risks could be for the client, right? And consider those, see those, be able to articulate those and, and mitigate them, right? Before they happen or, build into a deal, things that, ensure that, it is as smooth as it possibly can, after the fact. Obviously, the capital event and, the cap rate, the cost of the capital, the proceeds and all of that are relatively short term. It's really the risks are more relevant, I think, in the back end of these deals when something changes, right? When a dealer needs to sell their dealership or build, or the business is fluctuating in terms of profitability, and it may trip things. So I think it's really being an advisor and thinking about what could potentially be at risk in the future for the client, and putting ourselves in the in the shoes of the client to mitigate those situations, or put in place things that protect the client at all costs. But as far as risk to us, it's relatively low, and so because again we're facilitating these deals. I think as long as we are able to protect the client to the highest ability possible, our risk is low as well.
Yeah, and from our perspective, the risk is a little bit higher because we're the end user or end owner of the real estate. So we do very much care about how it impacts the credit worthiness of the dealer group that we're working with. That matters very much. I mean, we look at a lot of deals, and we pass on more than we move forward on because the advance might be too much, or what they're looking for doesn't make sense from a business perspective on the credit side of things. Sometimes it's the real estate, but it's more often the credit and the dealership group that we're working with that helps us to make that decision.
Great. Thanks, guys.
Yeah.
Kathy?
Dan, I just have one quick question for you also.
Sure.
What's like the minimum lease that you guys even consider?
Yeah, that's a great question. I don't know how to answer that without so as far as a transaction, we can do smaller transactions if there are multiple properties involved. So, if we're looking at a one-off deal, under 7 million is getting kind of small for us. But we could do 4 $3.5 million properties in one transaction. So, if the aggregate transaction is above 7 million, or that's about the sweet spot of where you would say it starts to make economic sense to move forward.
Great. Well, we went over a little bit with 111. It's pretty good.
All right. Well, thank you so much for having us.
I'm muted.
Thanks, y'all.
Yeah, thank you so much.
I don't know if you guys
appreciate the opportunity
can
to
hear me.
speak
I see
speak
I'm
with you, Dan,
frozen.
and with you, Ken.
Thank you guys.
And
Really
Alicia.
appreciate it. Always. Thanks, guys. Have a great
Thanks
rest
so
of the
much.
day.
Yeah,
As
have
well.
a good day.
Thank you.
All right. Bye, y'all.
Thank you.